Hello everyone, welcome to StashAway's weekly market updates. Today I have the pleasure of having a colleague of mine, Joyce, to join us. Joyce at StashAway, she's in charge of the business development for high net worth clients and private banking clients. She has extensive experience advising clients in those spaces, and hence it's with great pleasure I have her today to debate with me about markets.
Thank you, Freddy, for a very nice introduction. So it's time to grill you again. So let's get into the topics. Obviously, on everybody's mind now is the US government shutdown. It has been about 5 weeks since it was first shut down. So can you tell us a bit more about it, the economic impact it has on US and the global economy, as well as how it impacts markets and what should we expect going forward?
Well, as a background, just for our newcoming viewers, the shutdown happened on the 22nd of December over a very well televised meeting between the Democratic leaders and Trump himself. So Nancy Pelosi, Chuck Schumer, and Donald Trump had a big row at the White House, and Trump virtually took ownership of the shutdown. He effectively says he was very proud to shut down the government to fund border securities. Now that really plays to the Democrats' advantage, because in a typical shutdown gambit in the past, it's normally not the president that shut it down. And the person who shut it down tends to take the blame for all the inconveniences and impact on other people's lives. So in this case, it's quite unusual that the president himself initiated and takes the blame. And so that is a very important key, because it also means in a game theory perspective, the Democrats can just sit back, be passive, and let Donald Trump ramp up his own damages. It's all on him.
So it's been 5 weeks. I'm sure there's been substantial damages. Can you tell us a little bit about that?
Well, when you really look deeper to the impacts, I know the media focus a lot on the 800,000 people, the government workers who's now out of job, not getting paychecks. In fact, as of today in the US, it's the second Friday, and so it's the second paycheck being missed. So it's going to get a bit more media coverage. But the real damages are actually on contractors. The US governments are the biggest employer of independent contractors. And unlike the workers of governments, they don't get back pay or compensation for lost income when the government reopens. That's why economic estimates for the damages have recently gone up.
So is there a figure we can put to this kind of economic damages?
Oh, you have to pin me down, would you?
Of course.
Well, it's gone up from 0.05% per week to 0.13%.
And it's been about 5 weeks, so wow, that's quite significant, about
0.65% impact on GDP.
And US GDP is traditionally about 3%.
About 3%, yes.
So that's 1/5 of the GDP.
Yes.
And so I would expect perhaps some impact on the global markets, but it seems that the US equities and the bond market, well, we are actually seeing a better January than December. How does that work?
Well, it's a very chaotic question to answer, because a lot has gone on. I know Trump single-handedly have stirred a lot of things in the markets, more than just the shutdown. We have the trade war, and you know the trade war is kind of thawing. There's a lot more conversations going on. China's making more concessions. Obviously not good enough for the US side yet, but they're talking. So there's some sort of optimism that maybe by March we get some face-saving way of thawing the trade war further. Hopefully. So market's getting a bit of a rebound from that sentiment, but the shutdown's in the way of a full recovery. So that I'll be realistic. But also I think more importantly, when valuations are now much fairer, investors' pressure to reinvest for the long term is lower now. So valuation is another angle where actually things are improving.
Okay, so can I say that market sentiments have kind of already priced in a very bad case scenario, and given that economic fundamentals are still there, so the downside risk is maybe not as much as before all this government shutdown talk? came to fruition?
Well, it's a moving target, but
Yeah.
clearly market is a very fast, forward-looking engine of voting. Everybody votes in the markets, including you and I.
Yes.
And so I would say that at the moment the market is pricing in a lot of it, but of course, if the shutdown prolonged to something way more extensive, for sure the damages would be going up. However, the good news is the signs that Trump is now trying to play a lot of tricks more in the negotiations. He's now offering a 3-year extension for DACA, meaning the dreamers, the young child who came to US illegally. Under Obama, that program allows them to stay in the US, have driving license and get work permits.
And to pursue the American dream.
Well, they wouldn't be able to get citizenship through DACA, but they will be allowed to stay in the US and work and so on. So Trump seeks to abolish that, and now is offering back some of this DACA component back to the Democrats and say they will give you a 3-year extension. Now the Democrat will say, hey, in the first place you took it away. Why are you giving me a piece of something that you robbed from me? So there's a lot of gambit going on for a while. But the pressures on Trump, the damages will be bigger as it prolongs. So there's a seemingly willingness to start negotiating for real. I think that's why the markets are quite steady and steadfast at the moment.
Yeah, let's hope we can get over this soon and that an agreement will become too soon. So you mentioned a little bit about trade war as well. So
well, it's always in everybody's mind.
Yeah, so can you tell us a bit more of your takes on trade war? Where are we headed? And we do have a kind of a deadline by March, right? Something has to happen before March. How do you think this trade war has been affecting both, not just US, but also China economy and the global economy in general? How should we position for that?
Well, in the first place, the effect of the trade war on China and emerging markets have been exaggerated because there's already an impending slowdown, cyclical slowdown in China. And also the Chinese authorities in this cycle, they are intentionally trying to do more risk management of the economy.
That's right.
They're just to kick the can down with more short-term stimulus, right? So people tend to exaggerate the full impact of the trade war. But nonetheless, the trade war, if really gone full-blown and prolonged, same thing as the shutdown, would be a pretty negative event. The good news is on the trade war, the market has, again, a fast-moving pricing engine, has priced in a lot of it already. And so it is my personal opinion from the game theory angle that by March the ceasefire would end, but China and the US would have a face-saving way of kicking the can further down.
Okay.
Let's put it this way, Trump needed to chew on this team again into the 2020 election, where he would need to pick a fight again to win more popularity into the election. So I would caution investors not to react overly positively to March sort of truce, but continue to stick to your plan. Your long-term goals is more important, right? Focusing on the economic numbers is important, not events, but focusing on risk management, focusing on your dollar cost averaging plans for the long term. Setting those parameters right are the only way for you to have long-term success.
I mean, all these Trump's Twitters and his mood swings has really induced a lot of volatility into the market. We've seen easily 2 to 3 corrections last year in February, in August, and then in December.
Yes.
And I agree with you. I think Trump, he has to, well, he can't drag this trade tension for until his next election. He probably has to call a break somewhere in between, and then he'll bring back the issue again. So the question is, the volatility is still going to be in the market. How are we going to face it? And we're not going to lose out on all the opportunities in savings and investing your money meanwhile, right?
So really, Joyce had hit a very core part of our what we see on the StashAway's model and dashboards. We continue to see a pretty strong US economy. Yes, the growth was so strong, but now it's less strong. But hey, that's not the same as a recession or the bear markets. The rest of the world has done less well than the US, but there are a lot of the negativity has been priced in by the market. So there are actually still opportunities for long-term investors to accrue and build the portfolios, right? You just have to stay global and diversified. The US side will work well first. The emerging side takes more time, but you are building a very diversified portfolio. It didn't matter. So those are the same principle that doesn't change regardless of whether the trade war is finished or not.
Yeah.
Right?
So I think more importantly, it is about staying in the market, right? Because as years pass by, the economy is always growing and value is always being created. There's still inflation, no deflation. A cup of coffee that cost 50 cents 30 years ago costs $5 now. It's never going to go back to 50 cents. And similarly. So tell us a bit more about China. China, we've seen, yes, economic growth has been slowing down. It used to be above 8%, then 7%, and now it's close to
6.5%.
Yeah. And what kind of impact are we expecting on China economy due to the trade war? Is it really going to go down to like 3%, or is it going to be staying around 6%, or is it really going to negative because there's so much fear about this trade war, right?
We can do some numbers here just to give you a sense of where the market is today versus the very bad scenario.
Okay.
Summary is not far.
I love numbers. Let's talk numbers.
So if you adjust for the cyclical slowdown in China, China GDP without a trade war should have been 6.7%.
Okay.
And now it's been projected to go down to 6.3 on average, accounting for the $250 billion of tariffs that the US has slapped on China. And now if you assume the worst where the US go on all Chinese imports, all the $500 billion, so the impact then can see the Chinese GDP go further down to 5.9, right?
Okay.
So 6.7 versus 5.9, you can virtually see a 0.8 impact on Chinese GDP.
Okay.
Now, the way the stock market works is not to react one-to-one,
Yeah.
because the stock market will say, well, how many years of earnings are impacted by this sort of regime change. So the stock market will tend to react by 20 or even 30 times to that number. So if you do the math, 0.8% times 20 is a 16% negative impact. 0.8% times 30 is 24% negative impact.
Yeah.
How much did the Chinese stock market drop last year? Nearly 25%. Yeah, and the last few saving graces early in the year had brought it back to something around down 19%. So we are actually still very close to the very, very pessimistic scenario. Is mostly priced in.
Yeah.
The downside for long-term investors is very low. And in fact, people who's averaging into the markets now, you're buying more units with the same amount of contribution every single month. So it's really important to realize that you can be negative all you want, but a lot of it is already out there. It's not new. Everybody talks about it. The market prices reflected it. Instead of being overly negative along with the news flow, you should really step back and say, hey, I think this is the maximum impact. This is an opportunity.
Yeah. Right. Yeah, you made a very good point. I think for investors who are dollar cost averaging on a very disciplined basis, like on a monthly basis or some even on a weekly basis, you should not be so worried about changes in the market, because your entry point as the market goes down, it actually averages down your entry point, right? So I think I read somewhere something that's very interesting that I want to share with everyone. The S&P. So if you had bought into the S&P dollar by dollar cost averaging from 1995 to 2013, in that span of 18 years, where 1995 to 1998, the first 3 years it was going up, and over 18 years the compound annual growth rate of S&P itself is 8+%, as compared to if you entered by dollar cost averaging in the year 2000, in the midst of the dot-com bubble. So first 3 years you actually suffer from negative returns, and over the course of 18 years your compound annual growth rate is only about 5+%. But in the end, the portfolio where you entered in 2000, you actually end up with more money, because it's different when the S&P's compound annual growth rate compared to your dollar cost average compound annual growth rate will be different.
I think we got to separate the fact that you're risking your entire savings right away versus you are splitting your net worths, or you are actually using your spending habit. You are trying to save money from your salary that you receive every month, less your spending habits. You try to create more savings that you can invest in. That is a very real approach for most retail investors. That's real life. If so you're not someone with a lot of net worth, your risk is very different. And averaging in is almost always better than being exposed entirely.
Yeah.
And in particular with this volatile and flip-flopping
Very volatile
environment.
market.
Exactly.
In fact, for myself, I've changed my standing instruction from monthly to weekly because it's really, really volatile. Yeah, so let's get back to the topic. More about the economy, leading indicators. So
Right.
I know you love to talk about those and you always mention them in your market seminars. What are the leading economic indicators saying?
Yeah, users, I mean, StashAway tracks a lot, but I think to be useful to our users or our audience, you can do it yourself. Go online, you search for the Conference Board LEI, leading economy indices. It will pop up the websites and you can check their numbers and even their reports. They do write comments to when they release the numbers, telling you what's the status of the US economy and the Chinese economy. They cover most major economies in the world. And so, of course, they charge subscription for more detailed data, but you can see a lot for free. And at the moment, the US numbers have slowed this year from 7.1% year on year to 4.3%. But the surprise, positive one is on China.
Oh, really? Okay.
China's leading economy indices is sharply ascending versus the coincidence indicator, meaning something that's current versus forward-looking. It has shown a lot of surprise in positive surprises. So with the market as it is here, pricing almost fully most of the damages that you can expect with the trade war, it is really encouraging to see the leading indicator telling us otherwise. As we said, a data-driven approach is more consistent, has better battling average for the long-term investors than someone who speculates on the news flow.
It has less emotional biases too.
Yes.
Right. Great. We hope that we can expect more good news going to Chinese New Year because, well, it's the festive season and we want to enter the festive season with a good mood. So stay tuned. I think we've come to the end of this week's issue. Freddy, if you have any questions for him, please write down in the comment section. We'll hope to address it in the next issue.
Well, thank you, Joyce, and we hope to see you more often on this show with us. And,
as long as you invite me. So.
Yes, it's been great debating and discussing the markets with you. So TGIF and good weekends.
Thank you.